So if you believe that the market in 3 years, the rates are going to be lower and the markets are going to be better, then you go in and ask for that seller financing. Normally, people laugh at you when you ask for seller financing. The last 4 or 5 years has been very hard. But in these distressed markets in 2024, seller financing will be a real thing. I'll just say this bluntly. Anyone that is data-driven is not thinking inflation today. We are worrying about deflation.
So you're the first person talking about that.
Well, because I usually tend to be a few months ahead of the market, right? So bottom line is this.
Hello, everyone, and welcome to another episode of the Jack Boss Show. Today, we have Neil Bawa with us, who is a mad scientist, data scientist, who is specializing on all the data behind multifamily and land and how you actually take the land, put multifamily on it. He's currently building 10,000 townhomes, or has on a mission to put 10,000 townhomes. And it's all driven by data. Now, not only that, he's actually also has raised $300 million and put investors' money into $1 billion worth of multifamily. So we're talking to a real rock star right now in all aspects of, well, data, economic data, building data, you name it. Well, who am I to talk about it? Let's just get started. Welcome, Neil. How are you?
Fantastic. Thanks for having me on the show, Jack.
Wonderful. You're very welcome. I'm excited to have this conversation. So let's jump right into it. So what data do you look at to start with?
Well, I'll give you my philosophy first, and then I'll answer your question.
Absolutely.
One of the things I like to say is that the Bible got it wrong by one letter.
Okay.
Because it is not the meek that shall inherit the earth, Jack. It's the geek. It's the geek. Richest man in the world is a geek. Second richest is a geek. Third richest is a geek. Are you getting that pattern? Used to be that the richest people in the world were oil people, right? And today, the richest people in the world are data people, right? They're called technologists, but they're really people that thrive on data. And that's what I do. So I'm a computer science graduate. I'm a data scientist. And I look at everything from the lens of data, right? So I'm, think the matrix, think that the green letters are falling, and I'm basically looking at them and I'm trying to study them. And that has led me to invest in 16 different markets in the United States. Most people invest in 2 or 3 or 4, especially if they're doing what I do, which is, multifamily and build to rent, townhome development, those sorts of things. But I've invested in 16 different markets because I chase markets as they start their up curve. I track over 100 statistics on 323 metros in the United States. And then once I pick metros, then I track data on all of the cities within that metro. So for example, out of that 323, Jack, one is Kansas City. I'm not really interested in investing in Kansas City, but Kansas City has about 15 cities, and 2 of them look really, really good. One's called Shawnee, the other one's called Olathe. Nobody knows Shawnee or Olathe. Most people don't even know much about Kansas City. But my data says Shawnee and Olathe are incredible when you compare their income and their ability to pay rents to what the actual cost of construction, cost of land, and property taxes are in that market. The difference between those two is the widest, right, in the Midwest. And so that's what I'm looking for. I'm saying, what's your ability to pay? How many people do you have that can pay me rent? And then what is the cost for me to buy or build? And where in the United States out of 1,000 cities is the gap the greatest now?
Fascinating. So you track all that data and you look at it now. So what does the data tell you today?
So the first thing the data tells me today is probably not the best time to either buy or build in some of the fastest growing markets in the United States. That was true for many years. I was talking about ultra fast growing markets such as Austin, such as Phoenix and a bunch of others. And the data supported us, and we've made plenty of money in those markets. And today the data says these are amazing markets and will be amazing in the future, but today it doesn't make sense to invest in these markets because the supply-demand situation there is currently upside down. So the number of units that are coming in, that are pouring into Austin is shockingly high. The number of units that are coming into Phoenix, the number of units that are coming into, other big markets such as Dallas. And what that's doing is it's really pushing down rents. In fact, today, I'm going to actually see if I can read this. Yes. So today at 5 a.m. in the morning, Yardi Matrix, which is one of my favorite sources of free data, sends an email, and here's the subject line: supply growth slows US multifamily rents. Right? There's a huge amount of supply coming in. We've heard about, interest rates. We've heard about construction slowing down. None of that matters today. It matters 2 years from now, because it takes 2 to 3 years to build. So everything that's delivering today, we started working on that back in 2021 or back in 2022 when rates were low, when you could get 4.5%, 5% construction rate locked in. That's what's delivering today. So just because interest rates are high, just because construction costs are high, doesn't mean that that supply is affected. It's not affected at all in 2023 and 2024. And so you're going to have a lot of incoming supply. So my data shows today that it's the smaller metros, the less sexy metros, that are going to make profits for people, whether you're building or buying.
Okay, let's talk about that. Just like I live in Phoenix. So we bought last year 45 units, a smaller apartment complex here, but we bought it in a neighborhood that has been gentrifying for the last 20 years. So I 100% agree. I think I heard something like the Phoenix metro market is getting 40,000 units that are coming online in the next, year, 2 years. And
2 years.
And the absorption is only like 10 to 14,000 units a year. So in other words, we are going to take 3-4 years before that is absorbed, because we're getting an influx of like a whole bunch of people every year. 30, 50,000 people move here into Phoenix every year. But a lot of this product is not built in the infill lot locations. A lot of this product is built in the outskirts of town. So how does that picture affect micro-geographical distances? Like, for example, we don't see any impact right now. While in Phoenix, everyone says, I talk to other operators, they're like, yeah, rents are not growing, rents are going down. We have taken this property from $1,100, from $1,000 in rent, $1,050 in rent to $1,300 over the course of a year. And we believe we'll be at $1,450 after making some more massive improvements, like converting it from boiler chiller to individual HVACs, doing a lot of landscaping and so on, because everyone wants to be in this sub-market, because these are all 1-bedroom, 1-bath units, but just half a mile over north, they're $1 million homes. A mile north, they're $2 million homes. The 2 miles north is $10 million homes, and all of that is pushing down into that area. So how do you look at data at that micro level? And
I do, and I have a perfect answer for you. So the property, if it has boilers, and chillers, this is an older property.
Yes.
And so it's a C property that you're converting into a C plus or a B minus, right? So you're upgrading it to a C plus or a B minus. So the short answer is this, and it's not necessarily a good answer for Jack Bosch, but I'm going to just be honest and tell you what the data says.
Go ahead.
When new inventory comes into a market such as Phoenix, and Phoenix is the second hardest hit market for new inventory in the US, the first one being Austin. The first impact, the first 6 to 12 months, the impact is highest on Class A, and then there's a smaller impact in the first 12 months on Class B. On C, in the first 12 months, there is no impact. There's no impact because people are downgrading, right? So the A people are going to B and the B people are going to C because the economy is slowing at the same time, right? So what's happening is that you're still getting an influx of people that are coming in from the B side as those people are trying to push up their rents because they have a lot of new supply coming in, right? So they have to fight. So they're pushing up their rents a little bit. So some of those people are moving over to the C. So that's keeping you in equilibrium. Here's the thing. The same data that suggests that the second 12 months, when there's heavy delivery coming in, the C's start to get hit in rent. So Here's my prediction. So, and hopefully you call me back to your show in 1 year and we'll discuss this. You're going to see C rents flatten out. You're not going to see C rents going down, but we actually don't have a lot of evidence that incoming supply drops C rents. It drops A rents a lot. It drops B rents a little bit, and it flattens out C rents, right? So that the impact is there. It firstly takes time to get down from the A's, which is all the new construction, down to the C's. And then as the impact goes down, it reduces in strength. So the C's never, go into negative rent growth when there's a large amount of supply. So here's my prediction.
Well, that's good news for us.
Yeah, it is. It really is, because it's the right kind of asset class to have when you have these kinds of things happening. So to me, Class C rent growth in Phoenix in 2024 is going to be flat. Class B is going to be maybe -1 or 2%. And then Class A is going to be -3 or 4% because the bulk of the inventory coming into Phoenix is the next 12 months.
Okay, so Class A you only forecast 3 to 4% reduction. That's because I was thinking if such an influx coming into town, wouldn't it almost generate the opposite flow of tenants, because B tenants now can afford A-class products because there's so much of it that they have to drop the rent so much that it's only a small hop from a B property to an A property.
Yes, and that 4%, by the way, is 4 plus 12. Let me explain why. So you'll see rents drop by 4%, but every building in Phoenix that's a Class A building will offer 1 month for free. So that 1%, well, sorry, 4 plus 8. So that 8% is also, that 1 month is also equivalent to an 8% discount. So really what they'll be offering is 1 month for free plus 4%. If you count that, it's really a 12% discount for the Class A's. For the Class Bs, it's going to be a much smaller discount. Yes, you do lose. Bs lose some people to Class A's, yes. But actually, quite often what happens is that when rents drop a lot, it's some of the people that were looking to buy a home in that market. They look at it and say, this is too lucrative. They're giving me a month off. They're giving me 2 months off. I'm going to push back my decision and wait for the rates to come down. So Class A's will often, when you discount them heavily, they actually pull from the single family market.
Okay, very cool. Very, very, very. That's great information. So yeah, in our case, now again, let's continue with that example. In our case, based on our data analysis, obviously far less sophisticated than yours. I'm basically just looking around and driving around in the neighborhood. There's nothing being constructed new of any kind of significant size. Now on the same road, but there's 45 units are up the road. There's some townhomes being built, some 3-bedroom, 4 bedrooms, kind of things, and a small apartment things, so like with like 25 units here and so on, because it's all small infant lots of like an acre or so, acre, and the density is allowed is not huge, so you can't put 5-story high density places in there. But so there's nothing new being constructed within probably a 5-mile radius of that area, and again, so that shouldn't that buffer an area a little bit from
the answer is yes and no, right? So firstly, if rents in a metro fall, right, a submarket within that metro can be 3, 4, 5 points above that. So let's say overall rents in the metro fall 2%, right? Now you can be 5% above that, you can be 6% above that, so you can be +4. But you can't be +8, you can't be +10. That much variation in a metro is extremely difficult to see during a time when rents are flat or falling, because tenants start to get the feeling that they can get bargains, right? So they shop around a little bit more. When everything is going up continuously, the tenants just lock in the first place that they can get to, where they can sign a contract. But when they're aware that rents are flat or rents are going down, then they tend to shop around a little bit more. So yes, you can be, a micro market can be a little bit above. There was a recent article in The Real Deal which talked about San Antonio occupancy dropping to 88%. And as a result, San Antonio is just like Phoenix, huge market with massive influx of people coming in from Austin and Houston and Dallas, right? It's basically the cheapest market in Texas. And so 1.5 million people, a lot of folks coming in. So 88% is, really low occupancy. Normally it's around 93, 94. And as a result, their rents have dropped 1%. But there's a market called New Braunfels, which is in that metro, and rents are up 10.7%, according to The Real Deal, right? I don't even know if I believe that 10.7 number, but I think it's a good example to use that in a metro, you can have these kinds of variations, but it's extremely rare, right? So usually the top submarket in a metro is within 4 or 5 points of the average. And then you've got some submarkets which are at the bottom, and usually those are the ones that have the huge amount of inventory coming in.
Yeah. Okay. That makes total sense. Yeah. But it's good to know that, it's good to know that looking for these areas that are a little bit protected from new construction, and also that are just overall desirable because of they're just up and coming, gives you some natural protection from some of these factors, which is why, because I live in Phoenix for 24 years. I've had my eye on that exact neighborhood for quite a few years, until finally something came up that was priced right, and it was kind of a little bit of a distressed situation. We could get it at a good price, and we're very, very happy with how it's performing and where it's going. So,
well, Jack, I think you're in one of the best markets. Let's talk about Phoenix, because Phoenix is actually going to have an enormous amount of opportunity. I tell people, in 2024, especially the second half of 2024, one of the best markets to buy in the United States is Phoenix. And the reason for that is, yes, you are right that it's going to take 2 or 3 years for that inventory to, really sort of work its way through. But the bulk of the inventory is 2024. And then there's a good amount in the first half of 2025. And then there's not a lot coming into Phoenix after that, because construction basically at this point in Phoenix, it hasn't stopped, but it's slowed dramatically, right? So dramatically slow down. So by the second half of 2025, the Phoenix market will normalize and start moving forward again. And when Phoenix moves forward, it moves forward very quickly because they've got so much in migration, right? So if you're buying in the second half of 2024, you should see significant discounts because of two reasons. Number one, the supply, we talked about that. But here's a bigger reason. The 2013 Jobs Act essentially created a new industry called syndication. Syndication existed before, but it was tiny. It was people that had been doing it for 20 years. And then all of a sudden, there were tens of thousands of syndicators everywhere in the United States because of the Jobs Act, right? And what that allowed, the selling of securities and things like that, fractional shares in multifamily. So you know about that, right? Well, those syndicators, they are hubs in the United States for syndicators. One is Atlanta, the second one's Dallas, and the third one is Phoenix. Well, those hubs meant that in the peak of the multifamily market, which was Q4 of 2021 and Q1 of 2022, that 6-month peak, prices in Phoenix were absurd. They were ridiculous. They were unbelievably high, right? And because of that, and because of the fact that during those 6 months in Phoenix, hundreds of properties, maybe 100 properties in those 6 months were purchased way beyond the price that they should have been bought for. Those properties, they're going to come, they're 2-year, a lot of them have bridge loans, right? So those bridge loans are floating and the rates have gone up from, let's say, late 2021, your rate might have been 4 to 5%. And now today it's 8 to 9%, right? Also, some of them had rate caps, some of them didn't have rate caps. Well, those rate caps, even if they were there, they're going to start expiring by Q1 and Q2 of 2024.
And by the way, a rate cap, for anyone who doesn't know what that is, rate cap is basically you pay extra money at purchase in order to get almost like an insurance. It's an insurance that basically says if the interest rates go above that, then the insurance will come in and pay the extra money. So the bank still can charge more, but you as the syndicator don't have to pay more than a certain amount in interest rates. And that's a great insurance. It's very expensive, but it's a good insurance policy to have, which limits the amount that you pay for the loan. When that falls off,
until your rate cap expires, expires.
Exactly. Those things are like for a year or 2 years and so on. Obviously, the longer you do it, the more expensive they become, and they can cost hundreds of thousands of dollars. So most syndicators, if they're in the process of repositioning you and putting a lot of money into rehabs, they're only getting a year or 2 years rate caps because that alone costs a few $100,000 depending on the size of the property already, and they are about to expire. So go ahead, yes.
So those rate caps, I've been watching their expiration rates. This data is available if you know the right brokers. You need to know somebody from Fannie Mae, Freddie Mac, and in Phoenix, it is very, very likely that by the end of Q1, there will be a flood of properties on the market. Now, this is not 2008. So if you're starting, your mind's going to, you're thinking, they're going to send for 30 cents on the dollar and stuff like that. That's what happened in 2009. We're talking about 100 to 200 properties, right? We're not talking about, 200,000 homes in Phoenix in distress in 2009. Right. So not that kind of distress, but if you have simultaneously 50, 60, 100 properties all in the market in Phoenix at the same time, that's going to drive the prices down for a short duration. And we believe that duration is Q2, Q3, and Q4 of 2024, where everyone has to sell because they have no choice. The new rate cap's very expensive, so they have to raise millions of dollars. The bank won't give them, they can't refinance because the value of their property is dropped by 25 to 30%. So refinance is not an option. So everyone has to sell, and everyone's selling at the same time, which means that, you've got this plethora of properties and you're making basically stupid offers, and one of your offers is going to get accepted. So to me, there's a 3/4 opportunity in Phoenix to buy multifamily at 25 to 30% off the peak price. I think that's an amazing opportunity.
And it's already happening. So we have relationship with some lenders and with lots of brokers, and we've already been offered two properties. One in particular, it's a smaller one, 72 units. They bought it on the west side of town where the prices are not so crazy. It's a more workforce housing kind of neighborhood. And the loan amount on that property is already at $10.8 million. Plus, they probably put at least 25% down. So probably they bought this thing probably around $14 million. And they were entertaining an offer from us for $9 million. Somebody else came in and offered either 10, I think 10, and even 10 was too high right now for us. So we were like 9.5 was the most. Somebody offered 10. So they're selling this property for $10 million, even though they lose their own $3 million in, or $2 to $3 million in the deal. The bank loses about $1 million on the deal, and it's crazy. It's already happening right now.
And it's just the beginning, right? The wave hasn't really hit Phoenix yet. So these are just, you're seeing sort of the early ones that couldn't really hold on. Or maybe, they couldn't, they had an unsuccessful cash call. There's still people trying to do cash calls, and all that the cash calls buying them, Jack, is 6 months of operating bleed, and then they're back in the same situation. Yeah, right. So I think that the opportunity in Phoenix is really going to be tremendous for multifamily. Now, I have to tell you, when you buy in the second half of 2024, maybe you buy in June or July, you're not going to see much rent growth at all. You're probably going to see negative rent growth for those 6 months, because if you're in a submarket where there's 5 properties selling at the same time, well, then that submarket is probably hit harder than the one that you've purchased in, right? There was a sexy submarket 2 years ago, and everyone was buy, and everyone overpaid. So when all of these properties get sold, there's going to be a lot of competition. But by early 2025, I don't think it's hard to survive 6 to 12 months when you're buying a new property at a discount. I think the people that are buying are going to be in a pretty good position. Again, I'm not predicting that people are going to make the kind of sexy money that was made in multifamily in the last 4 years. That only happens if cap rates go back down to 4s. I think that may not happen for 6 or 7 years, but there's plenty of money to be made here when you're buying a property at a substantial discount.
And it also depends on what your outlook is. So there's a lot of investors that don't want to just get in for deals for 3 years and then get back out of the deals. They just want to buy in and over time make good cash flow and build a good asset value. So particularly those kind of investors is who we are looking for right now. I'm actually actively having meetings with people, with with accredited investors with deep pockets, to actually put together an investor team that can act on those kind of investments by the middle of next year, because I 100% agree, because we're starting to see it. Lenders are starting to reach out to us again and say, like, are you buying? We're like, yes. Okay. Anticipate Q1, Q2 of next year. They're saying exactly what you said. Anticipate us having some deals in your market coming along. And if you're ready, we are happy to pass them on to you. So we're like, okay, let's not sleep on this. Let's prepare for this. So I've had the lunch meeting the other day. I have a meeting yesterday. I have meetings next week. Not next week. What time that we're recording this is just before Thanksgiving. So right after Thanksgiving, I have meetings in order to line up exactly a set of like 20, 30, 40 investors like that with the ability to write 7-figure checks that can come in with me and those things. And not all of them want to have a 3-year flip. Some of them just say like, yeah, our private individuals, they're like, if you find a deal that produces good cash that we get at the right price, that over time produces a really solid cash flow, the depreciation and the value add over time, I'm all in. I'm all in holding that for the next 10 to 20 years. And that's something we're looking at too.
And it's the right approach, right? So this is the time for investors to understand that they can get deals. And what I'm seeing, Jack, which is silly, is, I'm seeing investors basically back away, because what has happened is they put money into syndication 2 years, 2.5 years ago, and all of those properties are doing cash calls. All of those properties are not distributing. So that's making investors think multifamily is not a good deal. And the answer is, well, if you buy at peak, right, it's never a good deal. Nothing's ever a good deal, no matter how strong an asset class is. Today is a good deal, right? Warren Buffett says, be fearful when others are greedy. Be greedy when others are fearful. So I was fearful in 2021, 2022. Even though I love Phoenix, I didn't buy anything in Phoenix. You know, and today I feel greedy. Today I'm like, wow, I know that interest rates are going to come down, right? So, you know, we saw yesterday's inflation numbers. Core inflation was at zero. The other form of inflation was at 0.2. These are fantastic numbers, by the way. Nobody was expecting inflation to come in this low in November 2023. So great numbers. And immediately I went and checked what the Fed traders, there's something known as basically people trade on what the Federal Reserve is going to do in terms of rates. And immediately I noticed that by July, a 50 basis point cut is what the market is now putting in based on what they're seeing on the inflation side, what they're seeing on the job side.
Great
And
point.
so
That's actually my next subject
right.
that I want to talk to you about inflation. What do you see based on the data? What do you see in inflation happening?
Okay, well, I'll just say this bluntly. Anyone that is data driven is not thinking inflation today. We are worrying about deflation. I mean,
Okay.
when you
Expand on
have
that, please. That's
inflation,
interesting. You're the first person talking about that.
well, because I usually tend to be a few months ahead of the market, right? So bottom line is this. We had sharp increase of inflation. It peaked at 9.2% in June 2022. We are now basically, you know, 14, 15, 16, 17 months down. And from 9.2, if you look at any inflation chart on the web, they're freely available. It is a smooth decline. And that's the Fed's done its job. They were late. And so, you know, obviously criticism there. But once they started, it's been a smooth decline, 9, 8, 7, 6, 5, 4, 3, 2. Now we're at 2, which is the Fed's number. The Federal Reserve is never trying to reduce inflation to zero because that's disastrous for the economy. They're trying to make it hit 2, 2.5%. That's their Goldilocks zone. And the numbers that came in a few weeks ago or a few days ago are basically one set of inflation at zero and the other measure at 2.4.
Okay, let's
so
go
we
back
are
to that
in
in
the
a
right
second.
range.
Why is it disastrous for the economy to have inflation at zero?
Because we never balance our budget. The government inflates away the US federal debt by using inflation. By using inflation, if you have, let's say you have 3% inflation over 10 years, basically you've cut the federal debt in half. This is not immediately obvious, but by reducing the value of money through inflation, they inflate away the debt. This is a strategy. It's a well-known strategy. Fed governors have spoken about this. So if we have inflation at zero, it becomes much harder to manage the debt, right? So they want inflation, but they don't want high inflation. High inflation is very problematic for debt service payments, just like right now. The federal government is really, really struggling with its payments because every bond that they're selling, instead of selling it at 1%, which is what they were doing 2 years ago, well, now they're selling a 10-year treasury at 4.5%. Which means that the government has to pay 4.5% interest on that bond for 10 years. And the government's not set up to pay 4.5% interest. They're set up to pay 1.5% to 2% interest. So all of a sudden, interest payments are becoming a massive portion of our federal budget. And that is a real problem. The Fed knows this. They want to get that number down as soon as possible.
So in other words, exactly that. So in other words, that means that the Fed has a very, very strong interest in reducing interest rates again so that they can get their payments in check again.
Absolutely, because the Fed's mandate is high employment and price stability. Price stability is impossible if the federal government cannot manage its debts. Because if the federal government cannot manage its debts, it's going to have to raise taxes tremendously. And a massive increase in taxes would create massive inflation, which is the exact opposite of what the Fed wants, which is price stability. So the Fed has to juggle two things. On the one side, it's dealing with the inflation monster, and it has to deal with it. It's its job to deal with it. But its other job is not to kill the economy. Remember, 9 times since World War II, the Federal Reserve has raised rates. 8 times it's put us into a recession. And the 9th time we narrowly avoided recession. This one looks like it may be the 2nd time where we narrowly avoid a recession. But the Fed's job, if they're honest about it, is to put the economy into a shallow recession, because nothing destroys inflation like demand destruction. And the definition of a US recession is negative demand, when demand dies, right?
Right.
There's too much supply, there's not enough demand. And that's the period when inflation usually is negative. So for a short amount of time, inflation in the US could be negative. And that's why I use that word, Jack. You're going to hear it more in the next 3 months. You're going to hear the word deflation. Deflation is a risk. And how does the Fed, and by the way, the Fed has enormously powerful weapons against inflation. They do not have a lot of weapons against inflation. They have a single weapon. You know what that is? Rate
Printing.
cuts. They cut rates. They cut rates because at that point, if the economy is going to deflation, there's negative demand. They're like, okay, we've done our job, right? And we're going to cut rates. Now, what they can also do, which you briefly referred to, is they can do what is known as quantitative easing. But at the moment, there's no need for that because you'd have to have a lot of deflation to try and quantitative easing. Their easier weapon is when they're at that point where they know that deflation is a bigger risk than inflation, which we are now at. In November 2023, the bigger risk to the US economy is from deflation than from inflation. I wouldn't have said that a quarter ago. I wouldn't have said, because some of the measures were still up at 4% inflation. But as of mid-November, those measures are down to 2% inflation, and the other measures are down to zero. So that's two ways of measuring inflation. One's at zero, one's at two. Well, all of a sudden it's like, okay, so now onwards, the Fed is like, I need to keep a watch on deflation because there's two monsters, the inflation monster and the bigger monster, which is deflation. So now they've basically got to keep an eye on that. Right. And that's why the market is saying 50 basis point rate cut by July, and then 100 basis point rate cut by the end of 2024. Well, that 100 basis point rate cut is a huge change in the way we do real estate.
That actually could also be saving a lot of the multifamilies if they have enough holding power to make it through that period.
Yes, but cap rates are a trailing indicator. So what that means is cap rates, once rates go up, it takes a year for cap rates to go down. To go up. And then once rates go down, it still takes another year for the cap rates to come down. And so some of them will survive. You're right. The ones
interest
that have
rates for refinancing get better. Like we have some properties that still have 4 years on the loan, but we invested a ton of money into those things out of our own pocket, for example. And we're looking at potentially refinancing that. Obviously, right now it doesn't make sense, but we're looking at refinancing potentially to also pay out our investors and keep that property for property. And I'm like, okay, obviously right now is not the good time. But this property has been held on a longer. Some investors want out and so on, that they're getting paid. Everything is good. But within a year, interest rates are percent lower than they are perhaps right now. The numbers might actually make sense to refinance that thing at that point.
For you, Jack. For you.
For me,
I mean,
yes.
for this
for me
property,
only,
yes. I think by the end of next year, let's say December 2024, yeah, I think folks like Jack Bosch are going to be refinancing. But the people that bought those properties in late 2021, early 2022, they actually need more than 100 basis points.
Because they bought it under 4%, and now they're still right now in the probably sevens or so. Now, if they stabilize the property and did all the upgrades in the meantime, then perhaps they can get a 6%,
right? So they can kick the can down the road
rate at that point of time. Right. And it may or may not work out, but it probably take a few people off, but 90% of them are still going to be distressed. Yeah.
Yeah, I'd say 80% will still be distressed if we see 100 basis point drop by the end of next year. 20% might escape by kicking the can down the road or having friendly lenders. So there's some outs, but I think the vast majority will still be sold at below the purchase price.
Yeah, makes sense. Good. So, well, this is great information. So almost like brand new information in a way, like, because obviously since rates just inflation rates just went down that low, it's really kind of like you're the first person I hear talking about deflation, about rate cuts, about things like that. This is really exciting news in a way. And at the same time, while it's sad for those investors who lose their money, it's also a great opportunity to put your team together and put your things together. So with you having raised $300 million and invested in $1 billion, what are you doing right now to prepare for second quarter and third quarter of 2024?
I'm preparing my investors. I have a webinar tonight. It's called Distress Watch, and I have 2,000 people signed up. So my goal right now is to tell people, I don't want to buy a lot today, which is November, but I want to be very greedy in Q2, Q3, Q4, because it's not just Phoenix that's going to have this kind of issue. Dallas is going to have it. Atlanta is going to have it. There's 5 or 6 metros that are basically going to get stuck in Q2, Q3, Q4 next
Which
year,
one
and
are
they'll have
those?
to. So Dallas, Atlanta for sure. Those are the ones that have a lot of inventory. Austin possibly, but it might get bailed out because it's very rich. Phoenix, and then you have some smaller metros. Denver might see some distress, and then possibly we might see distress in Tampa, in the Florida market. So, and then there's a bunch of smaller markets that I'm actually more interested in. But people like to know what the big markets that are going to have, 6 to 9 months of distress. What I mean by distress is lower prices than you would get elsewhere in the country for the same net operating income. So if NOI is $1 million, if somewhere else in the country the price is 20, in this market it's going to be 17. Well, that's $3 million that you just swept off the floor for just buying a property from the market, right? It's not even off market or any kind of deal. You can also, in that 9 months, you can do seller financing deals. There's going to be sellers that have a lot of equity in the property and they don't want to sell it for ultra cheap. And so you can go to them and say, you know what? I'll give you a good price. I'll give you a price that's $500,000 above market, but I want you to give me 3 years of seller financing at 6%, and I want you to finance half of the equity. And a lot of people will do it because they're still making 6%, right?
Yeah.
So it's not like they lose that money, that they're still making slightly above market. And why would you pay $500,000 above market? Because you're putting in half the equity, buddy. You're reducing the amount of equity, the amount of investors to half. That's going to shoot up your equity multiple. It's going to shoot up your IRR, right?
Absolutely.
And you have 3 years to return that money through a refinance, right? So if you believe that the market in 3 years, the rates are going to be lower and the markets are going to be better, then you go in and ask for that seller financing. Normally, people laugh at you when you ask for seller financing. The last 4 or 5 years has been very hard. But in these distressed markets in 2024, seller financing will be a real thing.
Yeah, I agree. And then again, particularly if it's a property with some value add that you can actually force appreciation, then it's a pretty calculable low risk to do that. Yeah, 100%.
I think so. I mean, again, the combination of discounts and seller financing is going to be hard to beat. So I'm preparing my investors. The other thing that I'm doing right now, which I think is very interesting, because over your left shoulder is this glowing neon sign that says land profits, right?
Right
and
there.
I'm not a land guy, right? You've got this amazing land institute, and you guys are doing land flips and then development. I'm a developer, right? Right now, what I am doing is I'm going to all of the markets in the United States that have low property taxes, including Arizona, low property taxes and low insurance and low construction costs. The trifecta is hard to find. You can find 2 of 3 out of 3 very easily, but the third 3 trifecta is very, very hard to find. And then I don't want very high supply. I also want markets that don't have huge numbers of units coming in. And I'm putting 10-acre parcels, some a little smaller, some a little bigger. I'm putting them in contract, but I'm only signing contracts where I don't have to close on the land for 18 months. This is not called land banking. It's called land squatting. So land banking is a process where you eventually will buy land and you'll wait for it to go up. Land squatting is a process where you put down deposits and you don't pay the land. I will have 4,000 units worth of land squatting complete by the end of Q1. And none of this would have been possible a year ago, because if I was to go to a land seller and say, I am going to sign a contract with you, which gives me 15 to 21 months to close, they'd be like, I'm not even going to look at your offer.
Right, because it was a hypermarket. But what do you do with those? Well, what do you do while you have them under contract? You take them to the entitlement process?
I get them to shovel ready. I take them. Yeah. So I have an in-house 5-person.
It's really land development in a way. It's
land development without purchase.
Yeah, without purchase. Yeah, absolutely.
Right. So that's really the key, because what was happening before, and that was driving my profits down, was that I would have to go buy this piece of land for 50% more in the 3rd month. And then basically I had carrying costs for it while I did entitlement. Also, entitlement was much slower because everybody was trying to entitle everything in the country. All of a sudden, today's cities, they have 30, 40, 50, 60% less applications coming in for entitlement. So the entitlement has sped up, right? And I don't have any carrying costs, and I'm paying 50% less for the land. Right? So to me, land squatting is actually my favorite strategy today. 4,000 units. And my mission in life is to build 10,000 affordable townhomes, not affordable housing. Affordable housing is, some cheap small apartment. I'm talking about beautiful, brand new, 9-foot ceiling, granite countertop townhomes. but they're still affordable because I don't build any amenities. No pool, no clubhouse, no gym. It's just a bunch of townhomes in a market, 100 to 150 of them. And my goal, this is the perfect time to build 10,000 of them because land squatting is so easy to do right now in my favorite markets in the US. So I have my team of 5 racing around. We've looked at, let me actually click on a slide here that's open. I was editing this for my board meeting that's later tomorrow or day after. I think we've looked at 1,350 parcels in the last 4 months. We have 4 in contract and 8 in LOI. So
Right.
that's
Where do you go find
parcels.
those parcels? Where do you look at the parcels?
So right now we're
software.
So we 6 or 7 different softwares. So the answer is, bottom line is I actually don't know the answer to that, Jack, because I have an incredible guy. His name's Daniel. He has done this kind of land development for 25 years. He's 50 years old and he's done it since the age of 25 with lots and lots of different guys. So he's extremely independent. He's got, an expert crack team that he's put together. His second in command has basically been doing zoning and entitlement for 15 years. These people know exactly what they're doing, right? So they're phenomenal at what they do. 1,350 parcels of land to process that. Imagine the amount of work that it takes. And to make 12 offers out of that, or 12 LOIs that have been accepted, 4 on contract. And I'll be at 40 parcels of land, which is 4,000 units. All of this is described, by the way, at mission10k.com. You use that word mission, right, at the beginning. My mission is mission10k.com. 10,000 townhomes, non-amenitized, not like fancy apartments. Everybody that builds apartments today, fancy infinity pools, gyms, massive clubhouses, all of that drives up the cost. What people want is an alternative to Class A apartments, right? These are people that are well off. They make good money, right?
Yeah.
And they were going to go buy a single family starter home before those homes became ridiculously expensive and mortgages went from 3% to 7.5% in 24 months. Well, they can't, that mortgage doesn't work for their income anymore, but they want to get as close to that single family starter home. Well, that's a brand new townhome with no amenities because no single family home in America has any amenities. Right? Yeah. A starter home doesn't have a pool, a gym, and a clubhouse.
That's right.
So to me, I'm looking at the opportunity and going, there's 20 million apartment units in the United States. 5% of that, 1 million, 5% of that is going to be built to rent, which essentially is townhomes, bunch of townhomes that people go live in, and they don't have any amenities except for, the usual cheap amenities. Let's call it a Central Park, a playground, a barbecue pit, dog run. Of course, you do all of those, right? They're nice amenities, but they're cheap amenities, right? So, but none of the expensive amenities. So that allows me to keep rents very low. And I'm running across these markets in the United States with ultra low construction cost. Ultra low is the word, right? Low land cost, maybe $2 to $7 a square foot is my range. And most of the time, 2 to 4. I haven't actually made any offers over $4 a square foot. And low property taxes like Arizona and low cost of insurance. If I can get all 4, I'm in business. Sometimes I get 3 out of 4, and the one that I'll allow to slip is insurance cost.
Yeah, but that is a subject for another podcast on its own. Currently, particularly in multifamily right now. Yes, but that's one of the big reasons why I'm abandoning several markets because of insurance costs, and I'm mainly looking for markets where insurance cost is low and more than anything predictable. Because the biggest part in certain markets is insurance cost is not. It's currently might be low, but it's not predictable because insurance might double next year and wipe out 30% of your NOI. And in other markets, where there's no natural disasters, insurance costs are low and predictable. Great. So with that said, give us again. You mentioned a couple of places where people can get a hold of you already. Give us those names again, or let us know how can somebody get a hold of you or learn more about this.
We do 12 webinars a year, about 25,000 people show up, and those webinars are stored at multifamilyu.com. So I have 2,000 people that have registered for the Distress Watch webinar tonight, and that's at multifamilyu.com. We do not provide paid education. There's no subscription. It's always been free. It always will be free. So join us there, and you'll have access to some of our projects when they come up. Right now, I'm not offering any projects. I'm just land squatting. And then the plan is at mission10k.com. So check out mission10k.com.
Wonderful. Well, with that said, thank you very much, Neil. That was fantastic. Hope you all learned a lot. And with that said, as always, give us a 5-star review. Hit that subscribe button. Wherever you're watching or listening to this, if it's on iTunes, make sure you subscribe, you share it with your friends, you give us the 5-star review, and see you at the next episode. Thank you very much.